Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Vincent Reinhart of BNY Investments. Vincent, what do you make of this GDP number rising 4.3% for the third quarter?
There's a lot of action in the rearview mirror, isn't there? I think part of what it does is make you wonder why the Federal Reserve felt the need to buy 0.75 percentage worth of insurance by cutting rates in September. But that was more about employment. What it does is worsen the disconnect we're having between our view of aggregate demand growing at such a rapid rate and employment, which is pretty sluggish.
Do you think that given this information is so stale, it's not going to make a difference? Or do you think Fed officials will look at this and take this information on with them as they consider and recalibrate what they should do in terms of interest rates in January?
Well, the important point you made was Fed officials. Remember, they're pretty divided. That it was a close call in terms of the overall 19 FOMC participants about the last rate cut. That means that almost half of them can look at this data point and say, why exactly were we doing what we were doing? So I think it does matter, and what it does is just heighten the really split within Federal Reserve officialdom.
Hey, Vince, I'm talking with my buddy Joe Bruce-Suelas. He's an economist down in Austin at RSM. And he sees a decoupling between the strong growth numbers that we're seeing, strong real final private demand, and weak hiring as AI, eats up jobs, and maybe we get robotics replacing people as well, longer term. What can cutting rates do for that kind of slowdown in hiring? I mean, if AI is taking jobs, even if you bring rates down 50, 75 basis points, is it going to matter?
Well, you do a little foaming in the runway. The Fed bought insurance. You're exactly right. And the question is, how expensive is that insurance? And the cost of it is that it'll be a little longer to get for them to the goal of 2% inflation next year. Now, if you're facing this enormous supply headwind on output, on rather labor, and headwind on labor and tailwind for demand, there's not a lot that the overnight federal funds rate can do. And I think you are right.
Is 2% truly the Fed's target? Because it doesn't look like they take that very seriously since we're 50% above it. I mean, CPI, I guess you could say, came in lighter than that in the last reading, but there was so much noise. It might as well be at 3.
Well, they never admit that. You don't give up on your goal when you're far away from it. So that's why Chair Powell vigorously defends 2% and denies any idea that they've changed their goal. I think 2% is a long-run aspiration, and what we've seen over the last 3 months in particular is that they're willing to put off that achievement to buy a little more insurance.
When it comes to this GDP data we just got, I'm already getting a lot of messages from viewers, Vincent, who are talking about the fact that if it's possible that CPI was inaccurate, do you think that it's possible this GDP data also has some inaccuracies in it as well?
The answer to the question, are there problems with government statistics, is always yes. And in this particular case, if we're not confident about prices, that they may be softer in measurement than they actually are, then real activity is going to be stronger because you're dividing nominal activity, which you're pretty confident about, by a mismeasured price level. So I think there was always an upside tail risk to this GDP print. It turned out to be even further upside.
I wonder what you make of policy that seems stimulative in the new year, right? We've got the tax refunds coming from the one big beautiful bill. We're dumping tens of billions of dollars out of helicopters on farmers in the Midwest because the Chinese aren't buying soybeans. And now President Trump wants to send, I guess, some kind of warrior dividend to soldiers.
Tariff dividend, too.
As well as a tariff dividend to most American people, while tariffs are pushing prices higher. Does that set us up for a bad inflation picture and the Fed cutting rates, obviously, a bad inflation picture in 2026?
I do believe that tariffs ultimately pass through to consumer prices. And two things have happened. One is we haven't seen all the pass-through of the increase in tariffs we've already gotten, and that over the course of the year, the effective tariff rate kept rising. So you're exactly right. There's more tariff feed through to consumer prices. That's why in our own forecast, we think that the insurance the Federal Reserve bought by cutting rates will be expensive next year. It's going to even further delay getting to a 2% goal. But got to recognize, Matt, that Congress set up the Fed for exactly this tension by giving it a dual mandate. It's supposed to foster maximum employment and stable prices in an environment in which, you're not happy with inflation. It's not at its goal of 2%, but it's a lot closer to 2% than it was previously. It weighs deviations on the employment mandate a little more heavily. And in this case, it's potential deviations. It's just worried about the slowness of the employment growth, the low hire, low fire labor market.
When it comes to inflation, though, we heard from the Treasury Secretary yesterday. He said once it's re-anchored, there should be a discussion about targeting a range. Do you think that's appropriate, Vincent?
So, in effect, the Federal Reserve hasn't been at 2% in a long time, and only in passing for a long stretch before 2020, inflation was below the Federal Reserve's goal. So a range makes sense. It works for other economies. The reality is the Federal Reserve asserted 2% was its numerical definition of inflation after getting frustrated that it couldn't have a good conversation with its leaders, i.e. the Congress, about how to make specific the goal. So yes, I think if the Treasury is signaling it's time to think hard about what the Federal Reserve's goal should be, that should be welcome.
Vince, I wonder what your take is on where the 10-year yield is going. I keep having this fight with ChatGPT, which tells me that the bond vigilantes are back. But I'm looking at 417 on the 10-year and like 70 points on the 2s, 10s. It doesn't look that bad to me. Do you think yields are going to go higher?
That's always a deep frustration, right? I come from a family in which we all worry about the federal debt and the untethered path for the deficits. We all worry about central bank independence, what's going to happen as the Federal Reserve changes next year. But the fact is, you don't really see it much in inflation and inflation expectations. Markets aren't really pricing in a lot of worries. I think we're in an environment in which employment is close to maximum, inflation is not that far away from the long-run goal. And so we're pretty much priced for an economy that's performing well. We haven't been stressed. And what you worry about, what I worry about, is exactly what will happen when we're stressed. And bond markets aren't particularly good at pricing in an unknown future stress.
Stay with us. More Bloomberg surveillance coming up after this.
Dan Skelly of Morgan Stanley Wealth Management says the outlook into 2026 remains constructive, supported by increased M&A, broadening out of earnings growth, AI diffusion, deregulation, and fiscal stimulus. Dan, thank you so much for joining us.
Good to see you, Emery.
I want to first get your reaction to what's going on with this GDP number. No one was expecting this big of a print, this high of a print, increase at 4.3%. That followed 3.8% growth. What's going on here? Are we actually seeing a robust economy? There's some data distortion?
Yeah, so I think what we're seeing is this paradigm shift continue. And we've seen this over the last several years, where when you look at the majority of spending in the economy, what's driving the economy, it's AI spending, it's services powered by high-income consumers, and all of those cohorts continue to hum along really strongly. So there's really been no change in that aspect of the economy.
We see the entire yield curve shift higher, swing just off this report. What does that mean for the deficit?
So it's not particularly positive, and we may hear an update in the coming weeks related to the Supreme Court ruling, related to the Emergency Power Authority or not. And so, look, I think be careful what you wish for, Emery,
right?
Because higher yields is not necessarily supportive of higher multiples.
So, but I'm assuming the reaction is, because this number is so high, there's much less of a chance that the Fed cuts rates in January. So you might as well buy the paper that's there now rather than the paper post-cut.
Yeah, I think that makes sense, man, and it's good to see you as well. And look, we've been saying persistently that the 5 to 7 year part of the curve is where we see value. We had been hesitant to extend that much out on the duration side of things. And look, I think on the equity front, just coming back to stocks, I think it's going to be a continuation of this cyclical rotation that we've seen really in the past 1 to 2 months.
We do have increasingly bullish expectations for earnings in 2026. I mean, it's not like the Fed is the only thing that drives markets, right? Obviously, the real economy is important, and I'm hearing from economists, been talking to Joe Bruce-Wallace here in my IB chat, that he still sees strong growth, strong final demand.
Listen, if we're running at a 7% nominal GDP, we would hope that the average company is going to see revenues increase, right? Because there's some correlation there. But I think the big catalyst for next year, Matt, is all about AI monetization. We've been waiting for Godot in terms of when does AI spread out from the Mag 7 to the rest of the Fortune 100. And frankly, I think that's where we could see upside surprise next year.
Can I just say that this goes along with Joe's decoupling theory. So if that's what's driving higher corporate profits, right, it's not going to help labor. We're not going to see a lot of hiring on the back of that.
No doubt. It's an excellent point. And look, we've observed over the last 6 months a huge divergence between JOLTS and job opening in the S&P. And so we do feel like in terms of that phrase again, paradigm shifts, that's going on in the equity market as well. Ultimately, we think stocks follow earnings. So while we could see some marginal degradation on the labor front, we don't think it's going to matter as much this time around.
And you only have one Fed cut baked in for next year. If we're seeing an unemployment rate that goes higher, how does the Fed calibrate for that AI-induced job losses?
Such a tough question. And look, the Fed is in uncharted territory, no doubt. The old playbook doesn't apply as much. When we talk about an economy that's powered by high-income consumers, they're not as rate sensitive. So by cutting too much, you run the risk of creating too much inflation, thereby hurting the 90% of the population that is inflation sensitive. And so look, Emery, if I think we're going to be surprised, it's going to be that the Fed doesn't cut as much next year.
How difficult is that going to be politically, given the fact that the one question the president, at least I have reporting on, he asked last time around for individuals who wanted to become Fed chair was, are you going to cut interest rates?
And look, I think it's a very thorny issue. Obviously, it's above my pay grade, but my speculation is whoever is in the chair is going to be dovish leaning. So the short end, no doubt, is likely to perhaps stay politically influenced, but it doesn't also entail the long end following. And so we may be kind of stuck in the mud in terms of this higher for longer long end.
Yeah, this is, I think, the concern of many, that the long end will continue to rise. Torsten Slok from Apollo putting out a chart this morning. Everybody reads his charts, showing that global yields could pull the U.S. Treasury yield higher. This is really a conundrum for the Fed, for the administration, isn't it?
Absolutely. And to your point on global yields, look at what's going on in Japan, right? So we're in a phase here where Japan is seeing 2% long bonds, and that could have some upward drift higher and thus kind of take global yields along with it.
How does the stock market deal with, I don't know what the correct phrase is, but an increasingly K-shaped economy, right? Because that's what it sounds like is happening.
So it's an excellent question. The stock market's response over the last several years has been increased narrowing up until this year. This is the first year where we've seen the Mag 7 go from a monolith, everything up in tandem, to a peloton where there's actual differentiation between the Mag 7. Money center banks are leading, and finally you've seen healthcare leading as of the last 3 months. So I think what the market is saying is that earnings matter more than ever right now. And even though we're in this extremely unique economic and kind of socioeconomic paradigm shift, I think earnings are going to be what drives stock prices.
What do you make of the potential policies we're going to get next year? I know we're going to get the tax refunds, which the Treasury Secretary loves to talk about. He thinks that's going to be huge. But a lot of people say actually consumers know that that's coming, so they're spending now. The president, though, is also talking about $2,000 tariff dividend checks. Is this all going to create a more complicated picture when it comes to inflation?
It could very well. And frankly, going back to our earlier thread related to monetary policy helping kind of middle income consumers, we actually do think it's going to be more on the fiscal side. And frankly, some of this may not coincidentally be timed in front of the midterms next year, where affordability and some of these other strains are starting to percolate in surveys and actual voting results. And so we think, again, fiscal policy is going to run it hot next year.
Stay with us. More Bloomberg surveillance coming up after this.
Stocks on pause after closing near record highs. Mona Mahajan of Edward Jones with a constructive outlook for next year, writing, elevated tech valuations, improving liquidity, and better earnings momentum across cyclicals, mid-caps, and international equities support a potential rotation. Mona joins us now. Mona, what gives you the confidence that we're actually going to see a real rotation when it comes to equities? Because we have been here before. We have seen a lot of false starts.
Yeah, it's a great call out. Look, it's year 3 now of growth outperforming value, of technology and AI leading the charge higher. But one thing that we watch carefully is, of course, earnings growth. And earnings growth for 2026, first, we think continues to look like it will head towards double digits. But the good news is underneath the surface, there is both tech and non-tech parts of the market that is driving that charge higher. And that is a difference from what we've seen in 2025 and really in the last couple of years, where it is the tech earnings that have driven most of the S&P corporate profits. So next year, more balance between growth, cyclical, and value, driving earnings growth higher. And by the way, as we think about a Fed that is cutting rates, that is an environment where valuations tend to expand. We don't see that much scope for valuation expansion in the tech and growth parts of the market. They've already seen some of that occur, but we do see potentially that scope for valuation expansion in that 493. So a couple of factors that could drive that part of the market higher and drive that rotation.
Does the Fed need to be cutting rates? I mean, if we're at 3+% in terms of GDP growth, a lot of Republicans are saying maybe 4. I saw Art Laffer on Fox yesterday say 5%. And inflation is at 3, unless you believe the last set of CPI numbers that we got. Does the Fed really need to be cutting rates?
Yeah, look, we don't think that's a prerequisite for the markets to continue to perform well here. We know that, in fact, the economy has grown when the Fed was at 4.25%, 5%. We have not seen, some of those recessionary conditions over the last couple of years that many economists had been calling for. So as we look towards 2026, where the Fed has brought rates down to under 4% now, we think the base case and what markets are pricing, which is 1 or 2 more potential rate cuts, is a reasonable kind of base case scenario for 2026. If you think inflation kind of ends in this 2.5% range or lands there, typically the Fed likes to bring Fed funds rate about 75 to 100 basis points above that level. So kind of 3.5% seems like a fair value for the Fed funds rate.
By the way, Mona, we've seen, I think, 175 basis points of rate cuts since September of 24. And in that time, the 10-year yield is up like 50 or 60 basis points. And Torsten Slok from Apollo out with a note today showing that we have German yields rising, Japanese yields rising, really highlighting the concern that a lot of people share. Global yields are going to continue to pull U.S. longer-term yields up. Does that worry you as well?
Yeah, look, our outlook for 2026 calls for a 10-year that stays in this 4 to 4.5% range. We think, the long end of the yield curve will be driven by, one, better economic fundamentals in the U.S., but two, global markets, as you noted, are also expected to see a real meaningful pickup in earnings growth next year as well. So there are global factors that are driving the U.S. yield higher. Now, keep in mind, 4.5%, if you look over a 15-year horizon, this is still towards the high end of a 10-year yield versus that history. And for investors that are in retirement, near retirement, or just looking for income, we're still looking at a pretty attractive value from an investment grade type bond market where you are getting 4% yield is close to, that 6-7% all-in income that you'd like to see. And by the way, above the rate of inflation as well. So we think balanced portfolios make a lot of sense heading into 2026.
When it comes to inflation, the debate isn't over, as you mentioned in your notes. What do you make of what we've heard recently from Beth Hammack saying that she wants to maintain policy right now, and she's going to be a voting member next year, maintain policy right now because she is concerned about inflation?
Yeah, I think generally what we're seeing is two parts of inflation, as we know, the goods inflation and the services inflation. And the goods basket of CPI is about a third of the basket. And we think there is potential for upward pressure, especially in that first half of the year, as some of those tariff rates continue to flow through to the end markets and the end consumer and consumer prices. But on the other hand, we have the services inflation, and that's largely driven by shelter and rent, about 75% of the basket. We think there is a reasonable case to be made that there could be at least some stabilization and even downward pressure there, especially as some of the trends we've seen recently in rent prices and home prices start to flow through the CPI basket. And so we remain comfortable that inflation hovers in this 2.5% range. We don't see it necessarily re-accelerating unless there is some exogenous shock to the system. So we think 2.5% to 3% remains a reasonable base case for next year on inflation. We think that still gives the Fed a little bit of room to bring rates, as we talked about, to that 3.5% Fed funds rate.
And you think the consumer can hold up in that environment?
Yeah, we think the consumer has held up in an environment even more severe than that over the last year or two. And as rates move lower, that should be supportive of course, consumer borrowing costs and corporate borrowing costs, especially on the short end of the curve. But as we know in the U.S., many have talked about this, the K-shaped consumer or the bifurcated consumer. And we know that low and middle income consumer is still perhaps struggling a bit to keep up after years of elevated inflation. But in the U.S., it is really the middle and upper income consumer that drive economic growth. And they, of course, have benefited from the wealth effects of better stock market prices, stabilization in home prices and real estate. And so overall, we're seeing the economic growth picture stabilize and even improve in recent years.
Stay with us. More Bloomberg surveillance coming up after this.
Warner Brothers reviewing Paramount's beefed up bid after receiving Larry Ellison's $40 billion personal guarantee to backstop the offer. The board, however, not modifying its position, continuing to support Netflix's competing bid. Peter Supino of Wolfe Research joins us now for more. Peter, I don't know where to start. I cannot wait to watch the movie of how this saga absolutely unfolded. Who do you think is actually going to win out in the end?
First, I want to praise you on that transition from obesity drugs to studios beefing up on buying each other. We think Paramount has a slight edge in what is a really tight horse race. These horses are neck and neck. The bids are tricky to compare. They're just $1 apart if you adjust for the various ways you should adjust them. The Warner board seems to be thinking about this like a house sale. Pretend you're selling your house and there are multiple bidders. Price matters and certainty of getting the money matters. And that's where this process is hung up.
So where the money matters, though, if you have Larry Ellison not just backing this by $40 billion, they're also talking about an increased offer when it comes to the regulatory fee if this was to break down. If this doesn't move the board, will anything?
So the board, in addition to being worried about price, is also thinking about the condition in which the business would exist if whatever deal they choose doesn't close. Both of these bids face regulatory scrutiny that's hard to forecast. I mean, it's Trump. And the plans for cost reductions inside of these two bids are very different. So Paramount has planned $6 billion of cost reductions, and Netflix has planned $3 billion of cost reductions. And Netflix plan is much more focused on streaming and technology costs, while Paramount's plan is more focused on studio savings. And that's where the Warner board gains comfort from Netflix, because they imagine if this deal were not to close, the studio business would be healthier a year or two in the future.
Peter, it does seem like the board doesn't matter as much if you're going directly to shareholders, right? And that's the one element that they didn't move. Paramount didn't move here. I mean, shareholders don't really care that much if there's a 5.8 or a 5.6 or a $5.9 billion breakup fee. Like, give me the money, right? If it's $30 a share, make it 33. If that's not enough, make it 35. Why don't they just raise their offer?
We think that they will. And the stock market, the arbitrage market that is currently setting Warner Brothers' price, is saying that Paramount or somebody will increase the offer price. In the meantime, though, the Paramount board needed to and did, at least to an extent, address the Warner board's concerns about certainty. And so the updated offer yesterday involved different language about the financial guarantee from the Ellison family, and it also involved different language about revocability, which is an arcane issue that matters to the Warner board. We wonder about the language relating to material adverse changes. The board also changed language about interim operating and financial controls by Paramount. So they're getting into the details of contract language to try to strike the best deal they can, and price probably comes next.
It's interesting that they're still trying to appease the board in a hostile takeover. I wonder about the employees. To your point, you know that Paramount wants to cut $6 billion in costs and Netflix only $3 billion. Of course, Netflix is not looking at the entire asset, right? That would be split off, or the cable elements would be split off. Michael Wolfe told me at one point that the creative community, though, is behind Paramount because they believe that David Ellison wants to make movies and show them in theaters, right? Whereas Netflix clearly has an aversity to that. They want to be streaming everything. And if it goes to the theater, maybe for a week before streaming release or at the same time. So it's a very different scenario.
Theaters are a consideration for the Hollywood community, as is the existence of a third studio-based streaming service. So imagine the streaming industry a few years from now as linear TV continues its gradual but inexorable decline and streaming continues to rise. With this combination, it seems credible to expect the Paramount Warner entity to compete head-to-head with Netflix and Disney among the streaming services that are based in Hollywood. And then there's, of course, the native technology companies, Apple, Amazon, YouTube, which are going to do their things. Their models are somewhat different. Without this deal, if Netflix swallows up Warner, it's possible that that list of Hollywood-based streaming services will end up being two major companies.
Matt, you got very passionate there. Do you still go to the theaters? Have you seen any good movies recently?
I do. I've seen One Battle After Another twice in the theater.
I've also seen that. Excellent.
I go to a lot of movies, probably once a week.
Peter, on that note, if Netflix loses or Paramount loses, where do you think each of them will look, given the fact that they wanted these assets so badly? Is there anywhere else they can go?
Well, I'm so glad that you asked, because we've been writing for years and with more intensity in the last year that NBC Universal really needs to do something for a lot of the same reasons that Paramount needs to do something. And NBC Universal has a very comfortable home inside of the Comcast conglomerate. But as a media business, it is both a wonderful producer of films and television and theme parks, and also quite subscale from a direct-to-consumer distribution standpoint. And so whoever doesn't win Warner Brothers ought to go out and try to do a deal with Brian Roberts, which is really difficult to do because Roberts has about 32% of the votes at Comcast and a history of liking his conglomerate structure.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.